We're watching it happen in slow motion. The market that once looked broken is quietly repairing itself. The sell-off shook confidence, traders ran for cover, and headlines screamed, "Crypto Winter 2." But beneath that noise, something completely different is happening. HBAR isn't just recovering, it's repositioning. If you're interested in this topic, hit the like button, subscribe, and type "interested" in the comments, and I will give you a heart. Most retail investors are staring at price charts, waiting for candles to turn green again. Institutions, however, are staring at something else entirely: the rails. Because when the money men start sniffing around DeFi, they don't look for hype, they look for infrastructure. And that's where Hedera has been quietly building its empire. You see, we've spent years calling this space decentralized finance, but let's be honest, most of it hasn't been truly decentralized and definitely not institutional grade. High gas fees, slow confirmation times, smart contracts that break faster than cheap umbrellas. You can't run trillions through that. You need something clean, compliant, and boringly reliable. That's where Hedera enters the picture. While everyone else was fighting about meme coins and dog mascots, Hedera was designing systems that look suspiciously like what Wall Street would build if it actually liked crypto. Infinite scalability, predictable low fees, verifiable compliance layers, the kind of stuff that doesn't make headlines but makes regulators nod in approval. Now think about this. Institutional DeFi isn't a dream anymore. Tokenization, the idea of turning real-world assets into digital tokens, is already being tested by banks, oil companies, and even governments. And stablecoins, they're the lifeblood that keeps those tokenized assets liquid. Hedera has both locked down. Its stablecoin studio and tokenization suite are like the backstage crew, making sure the show runs flawlessly. Institutions can build, issue, and trade compliant digital assets without worrying about hacks, downtime, or unpredictable costs. It's the bridge between old money and new code. Let's rewind a bit. Imagine you're the CFO of a mid-size investment firm in New York. You've watched crypto for years, nervous, skeptical, maybe even dismissive, but now your board is asking questions. What's our tokenization strategy? Why aren't we exploring on-chain finance? You can't just jump onto Ethereum and pray gas doesn't spike. You need a platform that behaves like a financial network, not a meme circus. That's when someone mentions Hedera. They show you metrics: energy efficiency 39 times higher than Visa, transaction finality under 5 seconds, and fees that don't fluctuate. Then they tell you it's governed by names you actually trust: IBM, Google, Boeing, Standard Bank. Suddenly, your eyes widen. Because the truth is, institutions crave safety. They'll move mountains for it. Now, let's talk about price for a second, because everyone watching wants that part. The chart looks messy: a big sell-off, fake wicks, confusion across exchanges. Binance, Kraken, Coinbase, all showing different lows. Some call them scam wicks. But the bigger story isn't those drops, it's what happened after. HBAR stabilized. It held a crucial support line from March, and in market psychology that matters. It means the believers didn't flinch, they accumulated. And that accumulation is usually what institutions love to see: a base forming before the real move. Now here's where I throw in a tiny story. A friend of mine, let's call him Mike, sold his HBAR stack back in May. Said he was done. Too slow, bro. Nothing's happening. Fast forward 3 months, he's texting me screenshots of Hedera's partnership list asking, wait, when did Arrow Electronics join the council? When did BlackRock start testing on RX Exchange? I told him, when you stopped paying attention. That's the thing about institutional adoption. It never announces itself with fireworks. It sneaks in quietly during the boredom phase. Now we're seeing DeFi slowly shift from the Wild West to Wall Street. Hedera's DeFi TVL is still small, about $98 million 0 cents. But that's the seed stage, because when you compare it to Ethereum or Solana, you realize something. Those networks are already crowded, expensive, and messy. Hedera, still early, and early is where the biggest ROI lives. Think about it. DeFi 2 won't look like degens aping into yield farms. It'll look like banks settling trades at 2 a.m. with near narrow fees, hedge funds tokenizing portfolios, and corporations running automated cash management on distributed ledgers that never sleep. HBAR isn't just aiming for retail excitement, it's architecting invisible adoption. So when we talk about the institutional FOMO coming, this is what we mean. It's not about CEOs tweeting, it's about compliance departments finally giving the green light. And I'll say this, the moment those green lights start flashing, there won't be enough liquidity on exchanges to handle the inflow. Because the same people who once mocked crypto will be the ones calling their analysts asking, how much Hedera do we hold? So what's the move now? Keep watching support zones, yes, but more importantly, start watching the partnerships, because partnerships reveal intent, and intent long before price tells you where the future money's heading. When we return in part 2, we'll dive deep into that. The exact upgrades, numbers, and proof that institutions are already testing Hedera's rails, and why this may be the biggest narrative shift since Ethereum's ICO days. But for now, remember this, FOMO doesn't start with retail hype, it starts with quiet confidence. And Hedera is exactly that, quiet, confident, and dangerously close to breaking out. All right, let's get serious for a second, but not too serious. Because what's happening right now with Hedera feels like that moment in a movie when the quiet scientist finally unveils the invention nobody believed in. Everyone laughs, then 10 minutes later the world changes. That's Hedera. The crypto world's been obsessed with shiny objects, meme coins, NFT hype, exchange drama, while the real revolution has been brewing in plain sight. Institutional grade DeFi, and here's the wild thing, it's not about replacing banks. It's about making banks need crypto more than crypto needs them. Let me explain. DeFi used to be the Wild West, gas fees sky high, anonymous devs vanishing overnight, liquidity pools draining faster than your phone battery. That's not sustainable. Institutions can't operate in chaos. They need rules, predictability, and data trails that regulators can actually read. And that's exactly what Hedera built. Hedera isn't competing to be the next meme playground, it's designing plumbing for the global economy. The stablecoin studio and tokenization suite are like the pipes and valves of a financial city that's about to come alive. If you've ever moved money internationally, you know it's slow, expensive, and full of middlemen who take their processing fee just to hit a button. Now imagine a system that does that in seconds, verifiable on a public ledger, compliant from day one, and green enough to make ESG investors smile. That's Hedera. And it's not just some theoretical promise, it's already happening. Take SaucerSwap, Hedera's main decentralized exchange. It quietly hit $5 billion in total trading volume. $5 billion. That's not just people swapping tokens, that's a statement. It means liquidity is growing, confidence is growing, and developers are sticking around. Think of SaucerSwap as the test kitchen, the place where Hedera's chefs perfect the recipe before the Michelin star guests arrive. And those guests, they're wearing suits. Because while retail traders are waiting for moonshots, institutional players are already setting the table. Earlier this year, Hedera's foundation started dropping breadcrumbs across social media. Clips, interviews, white papers, all pointing to a single narrative institutional DeFi is about to go live. This isn't about small partnerships or flashy names, it's about infrastructure adoption. Financial giants quietly testing smart contracts, compliant order books, and automated investment portfolios that rebalance without human error. And if you're wondering whether this is still talk, here's your proof. The RX Exchange just launched pool tokens on Hedera, and these aren't your average DeFi pools. They're backed by names like BlackRock, Aberdeen, State Street, and Legal & General. That's real institutional DNA entering crypto through the only network built to handle it. RX's model is simple but revolutionary. You deposit assets, you receive pool tokens, and those tokens represent automated portfolios that rebalance and optimize yield. Basically, it's the ETF model brought to blockchain, except instead of waiting for quarterly reports, rebalancing happens programmatically, every few minutes if needed. And the fees, pennies on the dollar. Ethereum could never. Now here's where it gets even crazier. Hedera's HIP 1249 upgrade. This isn't just a patch, it's a leap. It increases smart contract throughput by 10 to 20 times. That means you can execute tens of thousands of complex financial transactions per second on chain without the system choking. If that doesn't scream institutional ready, nothing does. Institutions aren't emotional traders, they're calculators. They're not looking for hype, they're looking for efficiency. When a platform like Hedera offers fixed micro fees, predictable performance, and zero downtime, it's like honey to the bees of global finance. Because for them, saving 1/10 of a cent per transaction scales to millions in operational savings per year. This is the part the average retail investor misses. While everyone's checking RSI and Fibonacci levels, the real alpha is understanding who's building the next rails of money. Hedera isn't trying to be a meme, it's trying to be mandatory. Let me tell you a short story. Back in 1999, I knew a guy named Phil Felfel, a stockbroker who thought the internet was a fad. He used to say, nobody's gonna shop online. People like talking to humans. By 2005, his firm was out of business. Amazon, eBay, and PayPal weren't memes. They were the infrastructure of the new economy. Right now, we're watching the same movie, only this time it's financial infrastructure. The players are different, BlackRock, State Street, Arrow Electronics, but the pattern is identical. By the time the public realizes what's happening, the foundations are already built. And speaking of Arrow, the $28 billion Fortune 500 company, they didn't just join the Hedera Council for fun. They're integrating HBAR into their global supply chain, tracking materials and optimizing logistics on-chain. That's not a crypto experiment, that's adoption in action. So the question becomes, if corporations are tokenizing their workflows and institutions are testing DeFi strategies on Hedera, what happens next? That's simple. Liquidity migration. Money follows efficiency, like water finds gravity. Once institutional players realize they can move capital faster, cheaper, and safer on Hedera, they'll move it, period. And when that happens, price won't crawl, it'll sprint. Because here's the secret. Institutions never chase hype, they create it. Up next, we'll uncover how Hedera's next phase, tokenized stocks, regulatory greenlights, and AI-powered DeFi portfolios could pull in trillions, not millions. And you'll see exactly why institutional FOMO isn't a theory anymore, it's already in motion. So here we are, the calm before the real storm, the point where most people think the excitement's over, when in reality, it's just beginning. Because while retail investors are obsessing over daily charts, something far more important is happening behind closed doors. It's the institutional awakening, and Hedera is sitting dead center of it. Let's start with what might be one of the biggest clues yet, tokenized US stocks. We're talking Apple, Tesla, and others live, tradable, and fully compliant on-chain. And guess who made it happen? Swarm Markets using Hedera. This isn't just another headline, it's a signal, because for the first time, real equities are being mirrored on a decentralized ledger. And not just for show, but for utility. Imagine trading Tesla at 2 a.m. on a Sunday, in real time, with instant settlement and zero middlemen. That's what Swarm and Hedera are quietly proving right now. The best part, they didn't build this on a speculative network. They built it on the one blockchain that doesn't allow front running, doesn't collapse under congestion, and actually satisfies regulatory grade compliance, Hedera Hashgraph. And here's what's wild. Greg Bell from the Hedera Foundation literally said it. This isn't just another crypto gimmick. It's the beginning of compliant DeFi enablement. When you tokenize public equities like Apple and Tesla on Hedera, you're not just flexing technology. You're rewriting what capital markets can look like. Because once these tokenized assets start interacting with decentralized exchanges, collateralization markets, and automated lending protocols, you've officially built an entirely new global financial system. One that doesn't sleep. And now let's talk scale. Everyone throws around trillions like confetti. But here's the uncomfortable truth. Those trillions are still locked behind institutional doors. They're waiting on rails that can actually handle compliance, transparency, and throughput at once. And guess which network already ticks those boxes? Yep, Hedera. Every box. Its consensus service provides built-in compliance for every trade. Its token service eliminates gas fee nightmares. And its governance council, with names like IBM, Google, and Standard Bank, gives it instant credibility with regulators. These aren't crypto startups, these are the companies that build the world's infrastructure. When they choose a blockchain to run financial systems on, they're not gambling, they're transitioning. Think about this, the RX exchange pool tokens we mentioned earlier, backed by State Street and BlackRock, are already representing billions in money market funds. Those aren't theoretical numbers. That's real capital quietly moving into tokenized rails. This is institutional DeFi in action. Automated rebalancing, yield aggregation, synthetic assets, all operating with the kind of precision Wall Street dreams about. And Hedera's fixed micro fee structure makes all of this possible. On Ethereum, rebalancing those portfolios would cost $100. 0 cents per transaction. On Hedera, less than a penny. That's not innovation, that's a paradigm shift. Now here's where it gets personal, because while we're watching these massive moves from afar, the question we should be asking is, how do we prepare? What does this mean for the individual investor? I'll tell you, the biggest edge you can have right now is awareness. Knowing before the crowd. Understanding that by the time CNBC announces institutional DeFi boom, the groundwork will already be complete. Just like the internet in 1997, we're watching the boring part. The cables being laid, the protocols being tested, the rules being written, and then suddenly it'll explode, seemingly overnight. Picture this: automated investment portfolios built on Hedera using AI to rebalance and optimize strategies in real time. A teacher in Florida or an engineer in the Philippines could own fractional shares of global portfolios, earning yield 24/7. No brokers, no delays, just programmable finance doing what it was always meant to do. That's the world Hedera is quietly unlocking. And the more you understand it, the more obvious it becomes why institutions can't afford to ignore it. Because here's the secret about FOMO. Institutions don't chase it emotionally. They chase it mathematically. Once one major player, say a global bank or sovereign fund, starts allocating serious liquidity into tokenized instruments on Hedera, the rest will follow like dominoes. It's not peer pressure, it's protocol pressure, efficiency pressure, regulatory pressure. You can't be the one still wiring money in 72 hours when your competitors are settling trades in 4 seconds. The moment that realization hits, the migration begins. And when that happens, there won't be enough supply, because right now most people still don't understand what they're holding. They think HBAR is just another coin. It's not. It's the fuel of a new financial internet, the one where money, identity, and ownership all coexist on the same transparent, regulated backbone. The one being built not by anonymous avatars, but by some of the world's most credible enterprises. Let's end with this. Hedera's story isn't about hype cycles or speculative pumps. It's about evolution, the shift from chaos to clarity, from speculation to structure, from maybe someday to it's already happening. And as retail investors, we're standing at the gate before the institutions fully walk through. This isn't a time for panic or disbelief. It's a time for study, for positioning, for understanding how global finance is being rewritten in real time, line by line, block by block, hash by hash. So next time someone tells you DeFi is dead or HBAR is just another coin, ask them one question. If that's true, why are trillion-dollar companies quietly building on it? Because when the smartest money in the world starts getting FOMO, not because of hype, but because of necessity, you'll know you were watching history in the making. And the best part, you were early enough to understand it.